Hey everyone, happy Wednesday. I hope you're having a good week. And today we're talking about what everyone in the financial and real estate markets is talking about. We're talking about the Fed and interest rates. We have some good news, or what we think is going to translate to good news. And the Fed has chosen to lower the federal funds rate by not 1/4%, but 0.5%, which is significantly more than we thought. Everybody in the industry was kind of anticipating a rate cut of about 0.25%. However, we got 0.5%. So what we're going to be talking about tonight is the news that the rate was cut. So we've got an article from CNBC that's going to talk about some of the details and kind of what the Fed's thinking, what they're anticipating, why they cut the rate, things like that. Plus, we have two more articles. We're going to talk about how these rate cuts will actually affect the housing market, home buyers, and home sellers. So we have a lot of good stuff coming up. I'm glad you could join us for the stream. Real quick, if you're new to the channel, my name is Joe. I'm a local real estate agent here in the Los Angeles area here in Southern California. And I'm glad that you found the channel, and I'm glad that you're watching. If you are enjoying the stream, if you're enjoying the content, please go ahead, hit that like button right below. Consider subscribing to the channel. It really does help me out. At any time, if you guys have any questions about real estate, rates, buying, selling, horror stories about real estate, please put them into the comments, put them into the chat. I would be happy to talk with you about that. Hey, David, thanks for joining, brother. Hope you're doing well. I just read a stat that Omaha, Nebraska has been ranked as the city with the most kind people. It's the kindest city in the United States. So good look for your city there, David. So let's jump into it. I'm going to get this pulled up here. Bingo. There we go. So that's right, folks. The Fed has slashed interest rates by 0.5 point, an aggressive start to its first easing campaign in 4 years. You know, normally these types of headlines where they use words like slash, aggressive, lowest, usually it's an exaggeration, right? Like it's the media doing the media thing, right? Hyping people up, getting that juicy headline to entice people to click or read the article or whatever. However, they absolutely did slash rates. I would say 0.5% is a slash, and it is very aggressive, and it is the first easing that they've done in 4 years. So actually, this is surprisingly a pretty accurate news headline for what we're seeing and what's going on. So some key takeaways. I'm going to make this a little bit bigger for you guys at home. There we go. So some key points to this article. One thing I love about CNBC, they give you the key points like right up front. That gives you kind of the meat and potatoes. So let's go over this, and then we'll dig in. Like I said, at any time, any questions, pop them into the chat. Love to hear from all you guys and hear what you think. The Federal Open Market Committee chose to lower its key overnight borrowing rate by 0.5 percentage point, or 50 basis points, amid signs that inflation was moderating and the labor market was weakening. It was the first interest rate cut since the early days of the COVID pandemic. The committee has gained greater confidence that inflation is moving sustainably toward 2% and judges that the risks to achieving its employment and inflation goals are roughly in balance, the Federal Reserve statement said. Remember, again, the Fed has this laser focus on keeping inflation below 2%. So what does that mean? Well, when inflation is at or below 2%, which is the target inflation rate, that means that the cost of goods going up is predictable and stable. It doesn't mean that costs are going to stay the same or go down. That would be deflation, which a lot of people feel like we need deflation in our economy, but there's also issues with that. So having this slight rate of inflation is actually good for the economy. It's where we should be. And the Fed feels like that we have, or that they have rather, taken the correct measures to hit that target sustainably and naturally without doing any other intervention. So, of course, this is something that we don't know what the long-term effects are. When I say long-term, 3 months out, 6 months out, 9 months out, or 12 months out. In fact, the general rule of thumb is that most rate changes take about 9 to 12 months at minimum to show any signs of effect. It's a very delayed lag laggy type of mechanism. It really takes a long time for the federal funds rate and interest rates. It takes a long time for those changes to actually trickle down and start, making actual changes for people in the everyday economy. So we'll just have to see. Although, the overall thing is that this is, probably a good indication that the Fed is, pretty happy with where things are at in the economy, because they wouldn't start loosening monetary policy if they weren't seeing the correct signs for it. Obviously, people will beg to differ. They'll say, well, Joe, it's an election year. And when we have a presidential election, rates always go down. And that's not incorrect. But I don't personally think that's the reason why we're seeing this rate cut. However, with the elections, it could be part of the reason that we're seeing a rate cut this large. I do think 0.5% is quite aggressive. I don't think it's so aggressive that we're going to have negative repercussions, but anything could happen. So let's dig into the article. Washington. The Federal Reserve on Wednesday enacted its first interest rate cut since the early days of the COVID pandemic, slicing 0.5 percentage point off benchmark rates in an effort to head off a slowdown in the labor market. With both the jobs picture and inflation softening, the central bank's Federal Open Market Committee chose to lower its key overnight borrowing rate by 0.5 percentage point or 50 basis points, affirming market expectations that had recently shifted from an outlook for a cut half that size, which again, that's what we were kind of thinking in the real estate world. A couple things I want to clear up really quick before we get any further. Okay, so the federal funds rate is not the mortgage interest rate. It's a very common misconception. A lot of people think that when the Fed lowers the interest rate, that's like directly happening to mortgage interest rates. Like, oh, the Fed just lowered it 0.5%. Mortgage rates just went from 6.5 to 6. No, that's not exactly how it works. In actuality, the way that it works is the Fed is cutting the federal funds rate or the overnight bank rate. And that's the rate that has more to do with things like credit card loans, car loans, student loan debt, and the interest rate on those loans. So we're not talking about directly mortgage rates. However, it does affect financial markets. And when the federal funds rate goes down, typically mortgage interest rates go down. There's no formal official coupling of those two rates, but that's what we see. We see that typically when the Fed funds rate goes down, interest rates go down, and vice versa. When the Fed funds rate goes up, like we saw in 22, 23, and 24, then we see mortgage interest rates also go up a little bit. So they are connected, but they're not the same. Additionally, you think, okay, well, what do the jobs picture and inflation softening have to do? Well, when interest rates, when inflation starts to get out of control and gets hot, the Fed wants to say, hey, we don't want people throwing as much money around. We got a lot of money circulating. A lot of people are throwing money around, both end consumers, but also businesses too, right? So what they don't want is they want to make it a little bit harder for money to be thrown around and spent. And if money is more expensive, businesses will pull back, right? And it makes a lot of sense. Imagine yourself a business owner and you need to open a second location. Let's just say you own a bakery, okay? And your bakery is very successful. You want to open a second location. You think, okay, well, I'm going to need to take a business loan because I got to buy land. I got to construct a bakery. Yeah, I gotta put a bunch of equipment in it. I got to hire more people, so on and so forth. So to expand the business, you're going to need a loan. Well, you're going to need a big loan to do that. It's going to be a lot of money. And if that interest rate on your loan is, let's say, 4%, okay, not too bad. But if that interest rate is 7.5%, that's going to cause you to go, hey, wait a second. I don't know if right now is the right time to do this. And I'm not going to spend this money. I'm not going to hire contractors. I'm not going to buy land. I'm not going to buy equipment. I'm not going to buy machinery. I'm not going to hire more people. Therefore, it's keeping the economy a little bit more constricted. So that federal funds rate moving, it can affect what businesses decide to do. So that's how the Fed kind of controls inflation, right? So when we have a lot of inflation, they raise the rate. It gets people to second guess spending money because it's going to cost more. It's going to be more expensive. And the jobs picture similar to that, right? So when a lot of people, when they see that unemployment tick up, right, and more people are out of work, they think, okay, well, we need to make it easier for businesses to want to hire people. Well, if we make that interest rate lower, businesses will expand, like our bakery example, right? Like that baker will open another bakery. And so when they open that bakery, they got to, buy some land. So they're going to employ title, escrow, real estate agents. They're going to then employ a contractor who's going to employ subcontractors, who's going to employ laborers to build it. Then they're going to have to buy some machinery. So they're going to buy from other businesses to, that'll obviously stimulate those businesses. And it's, there's kind of this cycle that happens. So that's why jobs is a very important metric when we're looking at interest rates. Let's continue. Outside of the emergency rate reductions during COVID, the last time the FOMC cut by 0.5 point was in 2008 during the global financial crisis. Again, we had crazy financial issues, and the Fed said, okay, let's lower rates. Let's try to keep people sustaining the economy, keep them spending, keep people engaged, keep people working so that they have jobs, so that they don't lose their homes and things like that. The decision lowers the federal funds rate to a range between 4.75 and 5%. While the rates set short-term borrowing costs for banks, it spills over into multiple consumer products, such as mortgages and auto loans and credit cards, which we were talking about. In addition to this reduction, the committee indicated through its dot plot the equivalent of 50 more basis points of cuts by the end of the year, close to market pricing. The matrix of individual officials' expectations pointed to another full percentage point in cuts by the end of 2025 and a 0.5 point in 2026. In all, the dot plot shows the benchmark rate coming down about 2 percentage points by Wednesday's move. So incredible to think about that we just did a 0.5 point. In 2025, by the end of 25, so a year from now, we're going to be looking at a full point rate reduction. And then in 2026, another 0.5. So we're looking at 2 percentage points in the next roughly 2 years, which is fairly aggressive. And that certainly will stimulate things quite a bit. And hopefully it has the positive effect that the Fed is intending. The committee has gained greater confidence that inflation is moving sustainably toward 2% and judges that the risks to achieving its employment inflation goals are roughly in balance, the post-meeting statement said. So here's a graph of the federal funds target rate. Again, not mortgage rates. This is the federal funds target rate. This is from July 2000 to September 2024. And so here you see it in July 3rd, 2000, it was up at 6.5%. And this was a little bit of the dot-com. I don't know, if you guys remember this, pop in the chat if you do, but in the early 2000s, there was a little bit of a dot-com bust. It did trigger a small recession. That's why there's this shaded area here that was only about a year long or so. But we did have a recession and the economy started to show signs of weakening. So boom, you can see they went from, 6.5 to 6 to 5, 5.5, 4, 4.5, and they kept dropping and dropping until we got in 2004. Things stabilized out. The rate was as low as 1% at that time. And then here we go. They started stepping them up. The economy started to heat up from 2004 to 2008, right? This was the ramp up to the great financial meltdown. So what you're seeing here is as the economy got hotter and hotter and hotter, the Fed said, whoa, easy, easy. And they started to incrementally adjust these rates. And we were looking at rate increases every about 2 months or so, because this went from this was in 1 month. September 13, it went up to half. Yeah, in October 13 to a half. And it just kept going up step by step by step by 0.25%. And then all of a sudden, the GFC hit, the great financial crisis hit, and boom, we hit another huge recession, a very big recession, a very aggressive recession, and down go the rates. It's like that famous box called "Down Go the Rates," down go the rates, and they were at rock bottom 0.125. I mean, practically zero, effectively 0% interest from, let's see here, December 29th, 2008, all the way to November 24th, 2015. They were basically zero. And then we started the recovery, and this was the recovery. And the Fed said, okay, things are recovering. Slowly increase this rate, slowly increase the rate. It's recovering. And then COVID, everyone's favorite time. COVID hit and they said, oh boy, okay, this could be a problem. We were starting to see some weakening. And here we are in February when they announced we're going to shut everything down, close the economy, can't do anything. All these businesses have to close, and boom, went way back down, back to its kind of 08, 09, 2010 level of 0.0125, again, effectively zero. And we saw what that did to mortgage interest rates, right? We saw that mortgage interest rates went down. It encouraged a lot of buyers to get active and into the market. And that's when we have the crazy COVID market, which I think we're all familiar with by this time. And then as inflation started to tick up, and in mid kind of 2022 is when we started to see this, boom, they started to very aggressively increase rates. And if you look at this rate increase, look how steep it is, even in comparison to here and here. This is a really steep interest rate increase. This is even steeper. So very, very, very aggressive interest rate adjustments in the upward direction to combat that very, very, very high inflation. And now they feel like they're at a good spot. They held them steady, and here we are on the backslide again. So it'll be interesting to see how it pans out going forward. The decision to ease came in light of progress on inflation and the balance of risks. Notably, the FOMC vote was 11-1, with Governor Michelle Bowman preferring a quarter-point move. So that means that there's 12 chair people on the FOMC, and 11 of them voted for half a point, and one voted for just a quarter, but they all voted to lower them, which is good. Bowman's dissent was the first by a Fed governor since 2005, though a number of regional presidents have cast no votes during the period. We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with this inflation. And wouldn't that be the ultimate goal, right? That's kind of the idea of the soft landing, is right there, is we want to restore pricing stability, but we don't want to do it by shock and awe. We don't want to do it by, keeping interest rates too high for too long, have a huge increase in unemployment. And because when we have a huge increase in unemployment, that's when the pain hits the people. That's when we have significant job loss. People can't make their rent, can't make their mortgage. They can't put food on the table. It becomes a real problem. So if we can avoid that huge spike in unemployment, but still have that pricing stability back in our market, well, that's really the ideal situation. And that's going to be the best outcome that we can really hope for. That's what we're trying to do. And I think you could take today's action as a sign of our strong commitment to achieve that goal, Chair Jerome Powell said at a news conference following the decision. Trading was volatile after the decision, with the Dow Jones Industrial Average jumping as much as 375 points after it was released, before easing somewhat as investors digested the news and considered what it suggests about the state of the economy. Stocks ended slightly lower on the day, while Treasury yields bounced higher. This is not the beginning of a series of 50 basis point cuts. The market was thinking to itself, if you go 50, another 50 has a high likelihood. But I think Powell probably dashed that idea to some extent, said Tom Porcelli, chief U.S. economist at PGIM Fixed Income. It's not that he thinks that's not going to happen. It's that he's not pre-committing. That's not correct. It's not written correctly, but that's okay. It's that he's not pre-committing to that happen. It's committing to that to happen. That is the right call. The committee noted that job gains have slowed and unemployment rate have moved up but remains low. FOMC officials raised their expected unemployment rate this year to 4.4% from the 4% projection at the last update in June, and lowered the inflation outlook to 2.3% from 2.6%. It's really important that when you look at unemployment data and you think, oh man, unemployment, it went up and it's going from 4% to 4.5% or whatever it may be. Keep in mind, anything under 6% is full employment. The U.S. considers that to be full employment. We're never going to have 100%. We're never going to have 0% unemployment, right? That's not possible because we have people that are disabled, elderly, things like that. But anything under 6%, full employment. Once that figure gets above 6%, that's when it's like, okay, unemployment's a little bit of a problem. But things are still looking good for that. The committee expects the long-run neutral rate to be around 2.9%, a level that has drifted higher as the Fed has struggled to get inflation down to 2%. The decision comes despite most economic indicators looking fairly solid. Gross domestic product, which is a big metric, GDP. GDP has been rising steadily, and the Atlanta Fed is tracking 3% growth in the third quarter based on continuing strength in the consumer spending. So GDP is just a measure of our overall economy, the size, how it's functioning. That's a good thing. Having 2-3% increases in GDP means the American economy is doing well. People are spending. There's innovation. Companies are bringing new products to the market. Companies are expanding. Businesses expanding. Typically a good thing. Moreover, the Fed chose to cut, even though most gauges indicate inflation well ahead of the central bank's 2% target. The Fed's preferred measure shows inflation running around 2.5%, well below its peak, but still higher than policymakers would like. And its peak was about 8%, if I'm not mistaken. So to have it at 2.5%, that's much closer to the 2% target. However, Powell and other policymakers in recent days have expressed concern about the labor market. While layoffs have shown little sign of rebounding, hiring has slowed significantly. So people aren't getting laid off, which is a good thing, but also people aren't being really hired as quickly or as often. In fact, the last time the monthly hiring rate was this low, 3.5% as a share of the labor force, the unemployment rate was above 6%. So interesting that we're at that same mark where, we have 3% for a hiring rate, 3.5% for a hiring rate rather, but we're not at that 6% of unemployment. And again, that 6% is when you're kind of like the alarms start going off. Like it's not a problem like right now, but it's going to be a problem if we don't get this under control. And if that unemployment rate does continue to go up, you better believe that the Fed will continue to aggressively cut interest rates. I don't think that's going to happen though. I personally don't see huge rates of unemployment increasing. There would have to be a significant change in the economic landscape in order to show any signs of major unemployment. Does that mean people will not get laid off? No, not necessarily. Layoffs happen. They happen during good business cycles and bad business cycles. It's part of it. But I don't think there's anything that's going to trigger companies to lay off en masse. At his news conference following the July meeting, Powell remarked that a 50 basis point cut was not something we're thinking about right now. Basically saying, listen, we cut it 50 basis points. We're not going to be, cutting it another 50 basis points, or we're not, that's not part of the plan to cut it another 50. So he's basically saying, yeah, we cut rates, but don't expect this to just, continue in the next month or two. Of course, economic data will shape and change all of this. And if something changes, then certainly Jerome Powell's sentiment could change. For the moment, at least, the move helps settle a contentious debate over how forceful the Fed should have been with the initial move. Increases the U.S. federal funds rate since 2022. So as you can see, here we are, March 22, increase 25, increase 50. And then this is the crazy one. Increase 75, increase 75, increase 75, increase 75. This is when the rates shot up with a lot of verticality. And they went wild, and they tapered down 50, 25, 25, 25. And then they just kind of held steady. So March of 2025 was when it really, really began to get wild in terms of interest rates increasing. And of course, that's when, that inflation started to rear its ugly head. There was a lot of money that was printed during the pandemic, and that money was being spent starting of March of 2022. However, it sets the stage for future questions over how far the central bank should go before it stops cutting. There was a wide dispersion among members for where they see rates heading in future years. Investors' conviction on the move vacillated in the days leading up to the meeting. Again, that's why a lot of people thought, hey, we're going to get 1/4 point. And then 1/2 point happened. So there was a lot of like, oh, we're not sure. We know that there's going to be a rate cut. We just don't know how much. Over the past week, the odds have shifted to a 1/2 point cut, with the probability for 50 basis points at 63% just before the decision coming down, according to the CME Group's Fed Watch Gauge, which, by the way, this Fed Watch Gauge is very, very interesting. It's something that I've shown you guys before. In fact, let me just share this tab really, really quick with you guys. So this talks about the next meeting. So the next meeting will be November 7th in 2024. So it's going to be coming up in early November. And they're thinking that there is about a 68% likelihood that we are going to get a rate cut. It's probably going to stay the same. And there's a 31% chance that they're going to cut rates again. So current, we have 475 to 500. So again, 68% chance that there's going to be a cut to that 450, 475 region, and which would be a quarter. And a 31% chance that we're going to see up to a half a rate cut. But it's extremely likely that we're going to see another rate cut come November. We'll have to see. This is a really great tool, and you can even look forward. So here's December 2024, looking at what they think. So they think, again, rates are probably going to come down in December. Of course, these are just predictions, tools, analytics. It doesn't mean that that's actually what's going to happen. The Fed last reduced rates on March 16th, 2020, part of an emergency response to an economic shutdown. We kind of talked about this. The current jobless level is 4.2%, drifting higher over the past year, though still at the level that would be considered full employment. This was an atypical big cut, Porcelli said. We're not knocking on recession's door. This easing and this bit cut is about recalibrating policy for the fact that inflation has slowed so much. With the Fed at the center of the global financial universe, Wednesday's decision likely will reverberate among the other central banks, several of whom already have started cutting. So that's like, banks in Europe and the European banks and banks in Japan and Asia, things like that, typically will kind of follow the Fed's footstep. The Fed is kind of, the center of the financial universe. The Bank of England, European Central Bank, and Canada's central bank all have cut rates recently, though others awaited the Fed's cue. While the Fed approved the rate cut, it left in place a program in which it is slowly reducing the size of its bond holdings. The process, nicknamed quantitative tightening, has brought the Fed's balance sheet down to $7.2 trillion, a reduction of about $1.7 trillion from its peak. The Fed is allowing up to $50 billion a month in maturing treasuries and mortgage-backed securities to roll off each month, down from the initial $95 billion when QT started. Wow. That is, just think about that. We're talking, $7.2 trillion on a federal balance sheet. Imagine having to look after $7.2 trillion, making sure it's all going to the right spot and it's all handled correctly. It's a pretty remarkable task. So now let's talk what this means for real estate, for home buyers, for home sellers. What's going on and how is this going to affect the housing market? A lot of people very excited about interest rate cuts because they think, hey, it's going to lower interest rates, which could increase housing affordability. And yes, it might do that. But a couple things to remember, the mortgage rate industry kind of works as a rumor mill. So even when there's the whisper that rates are going to get cut, mortgages cut their rates preemptively. And then we refer to that as baking in the interest rate cut. So basically what happened is the mortgage industry said, hey, we know there's going to be a rate cut coming on September 18th. We believe it's going to be a 0.25%. It could be 0.5%, but we know that we're going to get a rate cut. And when I say they know, it's not like Jerome Powell, sent them a DM on Instagram, was like, hey, we're cutting rates. Here's some inside information. That's not what's happening. But based on analyses, and different metrics and data, they are extremely confident. So rates have already adjusted, and that's what we call baking in that interest rate cut. So mortgage interest rates, they are not going to see this immediate decrease. Like I said earlier in the stream, we're not going to see mortgage interest rates go from 6.5% to 6% because this half rate was cut. That's not the way that it works, but it is a good thing for mortgage interest rates because it means that they're not likely to go up and only more likely to go down. What do you got for me, David? Joe, looking back to 2021 and 2020 and 2022, do you think the Fed should have raised rates earlier when inflation first took off? A lot of people love to second guess the Fed. A lot of people love to Monday morning quarterback and say, well, the Fed should do this or the Fed should do that. Or if I was the Fed, this is what I would have done. I think it's really important, first and foremost, to recognize that the Fed has an extremely difficult job. And it's oftentimes a very thankless job, because if the Fed gets it right, people go, yeah, well, this is what it should be. If the Fed gets it wrong, they pitchforks and torches, right? People get up in arms when the Fed doesn't do the right thing. So let's keep that in mind, first off. It's hard. I think my gut reaction is that I think the Fed played it out correctly. I do think that the Fed probably could have raised rates a little bit sooner and maybe a little bit more gradually. As you saw in that chart, we saw 4 or 5 rate cuts back to back, being 3/4 of a basis point. And those are steep. Those are very, very steep increases very quickly. And it could have been a little bit better to maybe try to soften that out. But at the end of the day, I think the Fed got it right. And I might have an unpopular opinion. And I think it's working. I mean, obviously it controlled inflation. Obviously unemployment's in a good spot. We'll just have to see how it affects things moving forward in the next 6 months. But I think overall, back when interest rates started to tick up, I think it was the correct thing to do. And I think overall the Fed, got it right. Yeah, I would not, the one job I wouldn't want to have, there's 2 jobs I could never imagine having. One, President of the United States. Half the people hate you already. Number 2, being on the Fed. Any Fed chairperson, that is a really, really, really tough job, because you are constantly under public scrutiny. And like I said, if you get it right, nobody cares. If you get it wrong, everybody hates you. So tough job to have. All right, so let's dig into 4 ways the Federal Reserve's big rate cut could change the housing market. And this is a very recent article. It just came out earlier this afternoon. After months of anticipation, the Federal Reserve cut interest rates on Wednesday by 0.5 percentage point. This will have an impact on the housing market, but it's unlikely to make a huge difference for those struggling to afford a home. Let's take a look. This pop-up, of course, comes up right at the wrong time. You guys can't see it on your end, but I got a pop-up that just came up. There we go. Mortgage rates might not actually drop much further right now. Again, this is kind of what we're talking about. Mortgage rates already accounted for this, so don't expect mortgage rates to drop like overnight. Mortgage rates have been pretty high for the last couple of years, especially compared to the historic lows they reached during the peak of the COVID-19 pandemic. Rates bottomed out below 3% for a 30-year fixed mortgage rate. Rates bottomed out below 3% for a 30-year fixed rate mortgage during 2020 and 2021, when the pandemic led to lockdowns, but they climbed to nearly 8% last year amid a robust economy and rising inflation. And again, while 3% for an interest mortgage for a 30-year fixed rate mortgage is like completely unheard of. It's crazy. The Fed is stuck doing a job that the politicians are afraid to do. Yeah, you're not wrong, right? You're not wrong. The politicians have to care about votes. They have to care about their image. They have to care about what people think. The Fed doesn't. The Fed's not voted. The Fed chair people are appointed. So yeah, you're exactly right. It's much easier for the Fed to be the bad guy than it is for the politician. In fact, during Trump's first presidency, he came right and said, Jerome Powell's terrible. And it's like, well, he's just trying to do the best that he can do. He's got a tough job. And it's easy for politicians to critique Jerome and the Fed and say, well, I can blame it on them. I can blame it on these people, and, I can deflect away from me. So yes, it is. I don't care how much money Jerome Powell makes. I don't care what the perks of the job are. You couldn't pay me to do it. There's no amount that would get me to do that job. All right, let's continue. Oh, I'm sharing the wrong article. You guys are probably like, what's going on? Share this tab instead. There we go. This probably works a lot better. But the prospect of rate cuts has already helped send mortgage rates lower. Even before the Fed announced its actual decision on Wednesday, long-term fixed rate mortgage rates are now at 6.2%, the lowest since February 2023. It's worth noting, though, that other factors besides the Federal Reserve's benchmark interest rate influence mortgage rates, including economic conditions. And that is true. 6.2% is a pretty good rate right now. Kind of the threshold that the industry, when I say the industry, I'm talking about the real estate industry, not the financial industry. The threshold that the real estate industry would like to see is about 5.5%. We think that at 5.5%, that's really going to start stimulating things. It's going to start to get people off the sidelines, both in two different groups. You have the first group that's going to come off the sideline, which is your garden variety home buyer. Your home buyer that's like, I want to buy a home, but I'm not paying 7.5%, 8%. I can barely afford the price of the home at 5.5%, but I can do it. At 7%, there's no question I can do it. So that's the first group that's going to get pulled back in. But the second group that could be motivated is actually property sellers, these people that have these golden handcuffs, the people that have the 3% interest rate or the 3.2% interest rate that they got during COVID. Those people might say, hey, you know what? I really don't want to leave my 3% rate to go to 5.5%, but I have a ton of equity in my house. I have a ton of buying power because I bought my house before the pandemic and now my house has gone up, 20 or 30% in value. So there's a lot of equity there. So I can put a huge down payment down and that will help offset my monthly payment with a higher interest rate than I have. So I think what we could do, what we could see is we could see a influx of people that go, you know what, I'll bite the bullet. I'll go for it. I'm going to go for the 2.5% interest rate increase because I really need a bigger home, or I really need a smaller home, or I really want to move to be closer to my family that's, 2 counties away or a state away or whatever the case may be, which would also be a good thing because that would help kind of raise that inventory up a little bit. This means effectively that the rate cut announced by the Federal Reserve may already be priced in. That's what we're talking about. They're baked in already. Though mortgage rates are bound to fall a little more given the policymakers have made clear they intend to continue cutting interest rates next year. So interest rates are not going to just go down today or tomorrow, but it does sound like they're going to continue to kind of trickle down, float down, do the step down thing over the course of the next 2 years. Charlie Doherty, a senior economist at Wells Fargo, expects mortgage rates to drop marginally after the Fed's rate cut on Wednesday. He and his colleagues forecast that the average rate on a 30-year fixed rate mortgage will be about 6.2% by the end of the year, where it is now. Now, it's important to note that if you've got good credit and you're willing to pay 3/4 of a point up front, some banks are offering 5.5% interest already. Now, you do have to pay a fee. You have to pay an upfront fee of several $1,000s, again, about 3/4 of a point of the loan. So you got to put some money up front. You got to put some skin in the game. But man, 5.5% for an interest rate, that is attainable right now for a 30-year conforming fixed loan through, I believe that's Bank of America, actually. So we're certainly getting to an arena that is much more favorable for buyers. David says the people with the golden handcuffs, when they enter the market, will really help the entry-level market. Yeah, you're exactly right. Those people that are looking to move up to the next home, it's a chain reaction, right? Somebody buys the move-up home, then the starter home becomes available. Then the person renting that bought the small condo can buy the small starter home. The person renting an apartment can then buy the small condo. And then the millennial the Gen Z that's living with the parents can then rent that apartment. And as more product becomes available, it should make things more affordable. But we'll have to see. That's a whole other topic, supply and demand, things like that. But you're exactly right, David, that when the golden handcuffs segment enters the market, it is going to help everyone greatly. Charlie and his colleagues we already read that. So Charlie expects the 30-year mortgage rate to fall closer to 5.5% by the end of 2025, still above pre-pandemic levels. Remember that 5.5%, I think that's the magic number. Barbara Cochran, she thinks that 5.99% is the magic number. She thinks that anything below 6.0 is going to start really motivating people. And, she could be right. It'll be interesting to see. But this is what I think. I think that next spring and summer is going to be very active in the real estate market. Again, this is going to depend on your location. Real estate is hyper local. In fact, I'm about to get that tattooed on my forehead. So when I do these streams, I don't have to keep repeating it. But real estate is hyper local. So your market may not change very much if interest rates go to 5.5% or 5.9%. But I think overall, if we hit that sub 5% or the sub 6% figure, anytime in January, February, March, April, May, I think that the spring and the summer months are going to see a lot more turnover, a lot more transactions, and a lot more interest in property. The only thing I fear with that is that as demand increases, supply has to increase. Otherwise, the price will increase. And we can't make homes overnight. We can't just, oh, we need to make some more homes. Okay, up the speed on the assembly line and pump out more homes. It doesn't really work that way. So it's going to take a long time to get to where we need to go with the supply issue. So my one fear is that if we do see an uptick because of low interest rates in home buyer demand, that we could start to see bidding wars, price increases, things like that. But we'll see. We've got to remain patient. We'll see what happens. Mortgage rates have already started to fall. So you can see here that just back here in April of 2024, so May of 2024, so just a few months ago, just 4 months ago, 7.2%. And now we're down a full point to 6.2%. So you can see, back in October, we were flirting with 8% rates. And now we're, flirting with seeing a 5 in front, 5.9. So interesting, where things are going. Definitely a help to home buyers and sellers out there. Low mortgage rates could actually mean higher housing prices. Wow, it's like I read this article before. This is exactly what we were just talking about. Here's the thing. Lower mortgage rates may not make it easier to buy a home. In fact, it could make it more difficult and lead to higher home prices. That's because lower mortgages are likely to lure more buyers back to the market, bringing in more competition for a limited supply of houses. That's tough for first-time buyers. Kim Cronenberger, a real estate agent in the Denver area, says she worries for the would-be home buyers who keep waiting for affordability to improve. And this is why, if you guys watch my streams regularly, this is why I said in my last stream, I think right now there's a golden opportunity for buyers. Yes, interest rates are going to go lower, and you might not get the lowest interest rate possible right now. But what we're seeing right now is we have a couple things coming together for home buyers. So if you are on the fence about buying a home, or if you are an active home buyer, listen up right now, okay? I'm talking directly to you. I think we have a window of opportunity. Number one, we're getting a slight increase in inventory. So that means more properties are coming onto the market. That means that you'll have more properties to choose from, and we have more supply, which leads to the second thing, which is we are starting to see some price cuts. Again, not in every single market, but we're starting to see homes stay on the market a little bit longer. We're starting to see sellers go, hey, oh man, I can't get that outrageous price that I thought I could get. I need to come back to reality. I'm going to cut my price a little bit. And the third thing is we are in the off season now. We're in the home buying off season. This is the real estate off season. And this is when homes on average will sell for $15,000 less than they do in the summertime. If you look at a chart of median home sales prices as it goes through the years, you'll see it always does this. And that's because of seasonality, right? In the wintertime, home prices get cheaper because less people buy and sell. Home prices get cheaper. So we're in this sweet spot where we have a little bit more inventory. There's not as much competition right now, and home prices are being cut in a lot of markets. So home buyers have this opportunity where it's like, hey, listen, interest rates are going to go down. You can refinance. You can refinance in a year and a half or a year when interest rates do hit 5.5% or whatever they're going to hit. And if you can get in the house now that you like, if you can afford the down payment now, if you can afford the monthly payment right now, get in. Because if you wait until spring and think, I'm going to wait for interest rates to drop a little bit more, I'm going to wait for the golden handcuff people to sell their homes, there's going to be more inventory. No, it could really end up biting you in the butt because of what this agent was talking about right here, that lower interest rates mean more buyers means more competition means more bids, more overbidding and higher pricing. So that is my tip. If you are interested in purchasing a home and you need a good agent, drop me a comment right now. You can do it in the live live stream. You can do it on the replay. I'm going to have a link in the description of the video after this video gets published. I'm also going to pin a comment after the live stream is over, and there will be a link there. If you're looking for a good agent, an agent that actually knows what they're doing, that can give you good advice, I can help you find an agent. I have a network all over the country. I know a lot of agents from all over the place, and I can help get you connected with an agent that can do a good job for you, whether you're buying or selling. So keep that in mind. Let's continue on with the article. These buyers have struggled to find their first home, as many were scared off by bidding wars during the low interest rate era, and then were rebuffed by high mortgage rates and still high prices. A lot of those buyers, they absolutely have regret. Yep. She says of people who didn't buy a home at the start of the pandemic when rates were low, but home prices hadn't yet skyrocketed, because had they bought 4 years ago, they would have been in a whole different place than they are now, which is true. Man, I think about the people that listened to the Crash Bros that said, during the pandemic, oh, the housing market's going to crash. This is crazy. Don't buy a home. The people that waited, the people that didn't buy a home, they lost out on a lot of equity, a lot of potential, a very good interest rate. Quite honestly, the Crash Bros cost them a lot of money, hundreds of thousands of dollars per person in money. And I'm not talking about everyone. I'm not saying everybody should have bought a home at the beginning of the pandemic. I'm talking to the people that could afford it, found something they liked, afford the payment. I mean, if you were at the beginning of the pandemic and you're just sitting on $50,000 to $100,000 and you could have afforded $2,000 a month for a mortgage, and you said, no, I'm going to wait. I'm going to tell you right now, you made a mistake. You messed up and you cost yourself a lot of money, and you have an opportunity now to potentially kind of correct that wrongdoing by buying now before the rates do skyrocket. Again, I'm only talking to the people that are in a good position to buy a house. I'm not saying everyone should go buy a house right now, because it might not be the right time for you. Don Payne, a real estate agent in Columbus, Ohio, says there's more inventory of larger homes for home buyers trading up. Builders are building them, and existing homes have those too. The big problem is a lack of starter homes. Yep, we've known this for a while. Folks are trying to get their first house, and there's a huge shortage on that, he says, which is absolutely true. Home builders are going, why would I build this little 1,200 square foot 2-bed, 2-bath home when I could build a 2,400 square foot 4-bed, 3-bath home? It doesn't cost me that much more to build the big home, maybe another 10% in cost, but I can sell it for 30% more in price, right? It's basic business. We do absolutely need to find a way to incentivize home builders to build starter homes, whether that's small condos, small single family detached, more duplexes, I don't know what, but we need to incentivize and stimulate builders to build smaller homes. Folks are trying to get their first home, and there's a huge shortage. Yep, we know this. Dropping interest rates could lead to more housing supply. Yes, it could. We talked about this a little bit. Let's dive deeper. A key reason for high home prices currently is the lack of housing supply. The U.S. is short millions of housing units. We've been short on housing units since about 2010. Supply has not kept pace with demand, especially as the large millennial generation is forming households and trying to buy homes. High interest rates didn't help, making it harder for some home builders to get projects off the ground, especially smaller private developers. Remember what we were talking about? Remember what I said, that high interest rates cause businesses, especially small businesses, to contract and recoil and say, hey, we're not going to expand. We're not going to start this new project because it's going to cost us too much dang money. Well, that hit home builders. So when we had higher interest rates, it cost home builders more money. And it got to the point where some of these smaller builders, they couldn't make it work. They couldn't pencil it out. It wasn't a viable business option. They said, forget it. We're not going to build small homes, or we're not going to build homes at all right now, because it doesn't make sense. That's because the rates on the loans the builders get for acquisition, development, and constructions are closely tied to the rates set by the Fed. So this rate cut should make it easier for those developers to get building again, which is a good thing. We need to increase that supply, right? We got to increase it so that we can hopefully stabilize pricing. The fact that lower mortgage rates are expected to spur more home buyers to buy will also serve as an incentive for builders to get building. That's good news for the supply side of the housing equation. More homes getting built and into the market will relieve some of the demand that pushes up prices. But of course, it will take time for those homes to be completed. Affordability will still be a big problem. I agree. Low mortgage rates can certainly bring down a home buyer's monthly mortgage payment, but when home prices are sky high, it will still be hard for many people to find a home they can afford. And here we see the median home price has risen 50% over the last 5 years. That is shocking. That is phenomenally impressive, and perhaps not in a good way. But here we are now when I look back at anything pre-2020, I just think of like before COVID, like that's the new BC. Before COVID, I just think to myself, how beautiful things were before COVID, how great things were. Things were stable, things were steady, things were affordable. There was no inflation, there was low interest rates, there was houses aplenty, and now it's a little bit different. So in just 5 years, we went from 280,000 and change for the median priced home all the way to 422,000. But you can still get a glimpse of what I was talking about earlier. You can see the seasonality here, right? So there was, some seasonality. It peaked up in the summer and spring and dipped down a little bit here in the wintertime. And then we hit February, it started to go up, March go up, April go up, the prime buying and selling season goes up. And then we get into the late summer, into the fall and the winter, it goes down, it goes back up here in the early spring. That's that seasonality effect that we see oftentimes in real estate. And that's why, as you can see, we're heading back towards this. Again, January dipped. If we just take this as an example, in June of 22, average price was 413. But in January of 23, not even a year later, just the next winter, that median price dropped to 360. And then it pops back up to 410. Then it went back down to 378. Ladies and gentlemen, we're about to be in one of these trough spots. It's starting right here. It's starting. This graph is going to continue to go down, and it's going to be somewhere over here. And that's when you want to buy a home. So that's why I said, if you are in a position to buy a home now, this could be a little bit of a window of opportunity to still get in while, the prices are a little bit lower than what they will be, 6-7 months from now. Doherty, the Wells Fargo economist, says home prices have risen about 50% since early 2020, faster than average household income growth during that time. That has been a really big driver in terms of making housing out of reach for a lot of prospective buyers. He says, during the pandemic, a huge number of homeowners refinanced their mortgages to take advantage of record low rates. I mean, I know I did. I refinanced my mortgage on the first house that I bought, and I think I ended up getting like 2.875. I did end up finding my wife and I our forever home in about April of 2022, right before interest rates really started to skyrocket. So we no longer have that rate, but we have a home that's going to be able to last us for the next 30 years. So we felt like it was a good trade. Plus, we were willing to take that increase in the interest rate because we had really good equity in our first home. We bought a fixer-upper, a small home with a great location. We put some money into it. We increased the value. The market went up, and we thought to ourselves, hey, yeah, we might be taking a higher interest rate, but with the money that we're going to make off this house and the equity, we can have a 20% down payment on this new house that we love, that we can live in forever. And it just made sense. And that's why I think that if we can get back to 5.5%, I think a lot of the people that have those golden handcuffs are going to have the same thought process and mentality that I did and say, hey, you know what? We can absorb the higher interest rate. We've made so much money on this house. When we go to sell it, we can put so much down on the next house that we're okay with taking the 2% interest rate hit. During the pandemic, a huge number of homeowners refinanced. It's nearly 60% of active mortgages now have rates below 4%, rates so low that homeowners are unlikely to refinance again. I don't know if we'll ever see 4% again. If we do, it could be a really, really long time. In fact, most homeowners are still going to be reluctant to sell their current home because they would face a higher mortgage rate today. Lower interest rates will somewhat reduce what's called the lock-in effect, but they won't change homeowners' hesitation, which is what we were just talking about. Greg McBride, chief financial analyst at bankrate.com, notes that even as mortgage rates have come down in recent weeks, it hasn't really jump-started the housing market. Home prices are still at record highs and inventory remains below pre-pandemic levels. He says neither of those variables are likely to improve dramatically in the near term. In other words, it will take more than the Fed's rate cut to fix America's housing problems. And I do agree. This is not a problem that we're just going to, cut rates. That's not going to get us out of this problem. What's going to get us out of this problem is increasing supply in homes. That's what's going to get us out of this problem. And again, that's very difficult to do. That's not something that we can just, crank up the speed on the assembly line. Let's shoot out more homes. Let's shoot out more properties and alleviate this problem. That's something that's going to take some time to do. And with growing demographics, the United States of America is only getting more people through, immigration, through birth rates. Millennials are a huge segment of population, one of the biggest demographics the United States has ever seen. Gen Z is not far behind, and they're getting into those beginning home buying years as well. So between the demographics that we have and the housing shortage that we have, we really need to build more housing. That's really the best way to get out of this mess. But at least things are improving somewhat, right? Things are slightly improving. I think that this is going to help affordability a little bit. I think best case scenario is that we get this interest rate cut. We get rates that are a little bit more favorable. Maybe we knock them down to 5.5%, and we just see a marginal increase in activity, right? Maybe we don't see buyers flood the market, because if buyers flood the market, that's going to cause prices to go up. So what we can hope for and what we can wish for is lower interest rates that will help builders build more homes, that will help some buyers get back into the market, but hopefully the market doesn't get flooded with buyers, because again, that would cause prices to go up. So I hope that you guys enjoyed the stream tonight. Again, thanks for stopping by the channel. I appreciate you guys taking the time out of your busy life to watch me talk to you guys for an hour. If you did enjoy the stream, please go ahead and drop a like right below. Consider subscribing to the channel. It's free. It doesn't cost you anything. It really helps me out. It helps the stream out. It helps the channel out. Again, we'll be back next Wednesday, 6:30 at our normal time for another stream. I hope you guys all have a wonderful, wonderful week, and I will see you next time. Bye-bye.